Hello, and welcome to In the DeNovo. I'm Will Grace, founder and managing director here at DeNovo Treasury, where we empower leaders of community financial institutions entering commercial and industrial banking with expertise for their strategic investment in treasury management products and services. We prioritize the how over the what. We believe in a collaborative journey and go beyond traditional services by actively transferring treasury management expertise to our clients. Thank you for joining us and staying in the know with In the DeNovo. Hello and welcome to episode 15 of In the DeNovo. I'm your host, Will Grace, founder and managing director of DeNovo Treasury. And today I'm joined by Peter Tapling, managing director of PTAP Advisory. Peter, welcome to In the DeNovo and thank you for joining us today.
Thanks for having me, Will.
Yeah, we appreciate it. And today's episode is titled Inside Payments Fraud, Trends, Tactics, and Prevention Strategies. And I pulled something from the 2024 AFP Payments Fraud and Control Survey report. And it documents that 80% of organizations were victims of payments fraud, attempts /attacks in 2023. So this is 15% point increase over the previous year. And I wanted to start our discussion with the question about the general payment fraud landscape, Peter. What are the most common types of fraud currently impacting payments fraud, impacting the financial institutions in general?
Yeah, well, we always in the fraud conversation love to reference the phrase, why do robbers rob banks? Because that's where the money is. And so that's still true. In this digital age, nefarious actors have figured out that they don't have to walk into a place with a gun and put themselves at personal peril. They just have to digitally try and convince someone that they should be sent money. So I think a few things. One is, what's old again is new again. What's old is new again, I guess. There are still account takeover attacks. There are still people harvesting passwords from breaches and trying to log into people's accounts. Business email compromise continues to grow. So business email compromise is when a nefarious actor acts like a business partner in order to misdirect a payment. And I think where a lot of the focus has been given, particularly in the last year and a half, is around scams. And in a scam, fraud's a broad umbrella. A scam definitely falls under the broad umbrella of a scam of fraud. A scam falls under the umbrella of fraud because someone is being defrauded of money. But the big difference is, in a scam, the party who is sending the money is actually authorizing the payment. And so the folks over in the UK gave us the phrase for this, authorized push payment fraud, or APP fraud. And so I think through this conversation we're going to have today is going to be pretty important that we kind of that we clearly delineate when we're talking about kind of historical types of fraud and when we're talking about APP fraud.
Yeah, and I real quick segue, or actually I want to stick with this APP fraud. And from what I remember, it used to be that senior citizens were the ones that were targeted with that. But I've heard a lot recently about kind of the romance fraud with this APP fraud. Is that the one that's most prevalent right now? Am I terming that one correctly?
Well, the Federal Reserve recently came out with a scams definitions white paper in which they actually outline a set of types of frauds with definitions. And I think that's very important because from the category of you manage what you measure, the exact question you're asking is a difficult one to respond to because we don't have people counting how many fraud events are romance versus elder abuse versus crypto versus whatever. And so I think what the efforts of the Fed work group is to begin to create those definitive categories so that people can start counting how many frauds of certain categories are actually occurring. To answer your question, when we have this conversation around authorized push payment fraud, and actually this comes up when I talk to community financial institutions about when and how they're going to become a send financial institution on the instant payments rails. And of course, they're worried about fraud. But we've had this problem for years. Anyone who's worked in a wire room at a bank has had the Aunt May problem. And I apologize in advance to anyone out there who has an Aunt May. But, the Aunt May problem is Aunt May comes into the bank, and fills out the piece of paper and says, I need to wire $50,000 to the Philippines. Why? Well, because I've met someone and he's going to take that money, he's going to fly to the US, we're going to get married, live happily ever after. And because we treat wires differently, because we put 100 years of banking theater around a wire transaction intentionally to slow it down before it hits the rail, because we know once it hits the rail, it's irrevocable. And so I think coming forward, romance scams aren't any different. There are different forms of romance scams. There's the straight up trying to befriend someone and get little amounts of money. More prevalent recently is the attack that's called pig butchering. The reference to that is the nefarious actors interact with the target over and over and over again to build up a lot of trust, to the point where through the whole building up of trust, they're not even asking for money. But then at the very end, they ask for a very big bit of money, and poof, that money's gone. So I think that all scams have kind of three characteristics, right? Authority, urgency, and action. They want to sound like they're someone from a position of authority, or from urgency. You have to do it now. This is really important. And action. I want you to do something. I want you to send me money.
Very good. Thank you for taking that side trip with me. So how is payments fraud?
Hey, you're the guy that said, let's stick to the script. So if you go off,
I did. Well, and I went off it immediately, didn't I? So how has the payments fraud landscape evolved the past few years with the advancement of technology?
I think that we can all look back to COVID and point to an inflection in fraudulent activity digitally. If you think about the way banks interacted with customers prior to 2020, it was all about customer interaction. We could have business processes where the nature of the business process is, if the risk had got to a certain point, you need to come into the branch, or we need to come and see you. 2020 happened, and all of a sudden there were no carbon-based interactions. Everything was digital. And so that meant that anyone who is signing up for an account, anyone who is signing up to do wires for the very first time, anyone who is trying to add a second signatory to a dual signature situation, all of that had to be done digitally. And that's hard. And early on, we weren't as good at it as we needed to be. I think we're getting better at it, but I think the bad guys figured out along the way, wow, this digital thing, this is way easier than walking into a bank branch with a gun. And so they just keep doing it. The challenge to financial institutions is we have to be right all the time. A bad guy can try and attack 1,000 times, 100,000 times, and if they're only successful 5 or 7 times, they've had a good week.
Yeah. Is there any one payment channel that's more vulnerable than the others, or one versus another?
There's not. I mean, at the end of the day, bad guys like instant too. But here in the United States, we're not really a big user of instant payments. The instant payment networks are very nascent. So where are bad guys moving money? Well, they still move money over ACH. They still move money over check. There's a well-publicized story of a type of fraud that's employment fraud. So I convince you that I'm a good guy and you're going to work for me. I'm going to send money. I need you to set up a bank account. I'm going to send you money to that bank account. I'm going to ask you to send that money somewhere else. And so that ask you to send money somewhere else, highly publicized story where it was wire. it was ACH. It was walk into the branch and get a cashier's check. So any way that money can be moved, the bad guys are willing to exfiltrate money that way.
Interesting. Interesting. So before I ask the next question about payments fraud or fraud prevention strategies, for those of our viewers who don't know Peter, we're extremely lucky and grateful to have him here on our program today. He's an expert in payments, identity management, and fintech, and leveraging technology to solve problems like fraud in our industry. He's a much sought after keynote and panelist speaker. Peter, why don't you share more about yourself and about your journey and how you've gotten to where you are today?
Yeah, you wow, man, I love the way I sounded right there, Will. Thank you. My background, my background's technology. Long ago and far away, used to write code. Spent a number of years long ago and far away. We used to call it data security, working in the data processing department. But spent years in the cryptography space, years in the identity space, and probably for the last 25 years, you can't do payments without strong identity, without encryption, without security. And so all of the things I was doing in information security and identity overlapped with requirements related to payments. And so, being kind of a student of the markets in which I operate, I dove deep into trying to understand how do payment systems work, who are the players, what are the different payment mechanisms. And so, along the way, I've had the great pleasure at a lot of venues to address audiences on the various topics that you talked about. But I think the most important thing, and I guess I'll leave you and your audience with this, is always be a student of the industry. Things change so much in payments, and the various payment rails are so deep. There's such a level of detail that you can get to. Just continue to be a student, and as long as you're a good student, you'll always be able to do something interesting.
Yeah, you've done many interesting things. So if you don't know about Peter, look him up. He's a very fascinating guy, and we're good.
Turns out there's only one Peter Tapling on all of LinkedIn.
Yes, that's awesome. That's awesome for you. So my next question is, what are the key strategies for detecting and preventing fraud in real-time payments and the real-time payment systems?
Yeah, so I would say that a lot of the tools and techniques are tools and techniques we use today, but kind of doing a point-counterpoint between traditional ACH transactions and instant payments. In traditional ACH transactions, all day long, payment instructions are being collected and they're being put into a bucket. At some point, that bucket will be evaluated for fraud and risk management. That bucket then gets handed over to an operator. The operator is going to do their own fraud and risk management, at which point it gets handed over to a receiver and they get to do their risk management. Oh, by the way, that happens over a lengthy period of time, standard ACH, 2 days roughly. And importantly, even if I miss something along the way, there are operating rules in the network about how to unwind a transaction or to have the opportunity to unwind a transaction. In the instant payment rails as they're implemented, all those buckets go away. That does not mean that as the sender of a transaction, you have zero opportunity to do risk management. Instant payments are only instant at the moment you put them on the rail. You have as much time as you want before that to decide whether or not I'm going to do the payment. And in fact, one of the strategies that I've heard of from financial institutions who are, using instant payments capability through a P2P app that you might know the name of. And they're like, well, what do we do? And they said, you know what, if this is the first time payment to a new recipient, we're just going to slow it down. We're going to tell the person we're not sending it for 2 days. And so the payment's not an instant payment till it's put on the rail. And if you decide not to put it on the rail, what happened in that exchange was they kind of changed the basis of the bargain for the instant payment, right? For the customer, but they did it for a valid reason. And so if I'm sending money to my kid at college to be able to have money in their bank account for the weekend or buy books or travel home or do whatever, I'm doing that over and over and over again. Those are relatively safe transactions. And so I think as an industry, we can deliver the instant payments value proposition in the 99 point high other digits percent of transactions that are valid, and put in place mechanisms with communication to the user being very clear about, hey, this is how it's going to work, that say, you need to send one of these things once or twice first, before I begin to allow you to trust the party on the other side.
That's not unlike the processes that we've implemented for ACH and wire when we look for, and even when it gets to be out of band too, right? Even when you're up and running as a small business, or with an ACH or a wire transaction, when you get to a point where you have something that's out of character, your financial institution is going to stop and ask some questions about it. So this isn't out of character for what we've done with the other payment systems.
Yeah, and the big thing is this irrevocability. So particularly RTP and FedNow, the payments are irrevocable, which means that once the payment goes, you can't get the money back. Well, asterisk. There is a request for return of payment message. There is the ability to pick up the bank on the other side and try and remediate a transaction. Oh, by the way, what does that look like? It looks like what we do with wires today. We screw up wires once in a while. And when we do, we pick up the phone, call the bank on the other side, and say, hey, can you help me out? Some percentage of the time, they can resolve the situation. Other percentage of the time, the money's gone, right? So I think that one of the challenges is, you go back 5 or 7 years, Will, and as a consumer, you couldn't do a wire without physically walking into a branch and filling out a piece of paper. There was no online wire doing. And so what's making banks nervous is as we look at the instant payment rails and we say, hey, we're going to try and create, the consumerization of payments for businesses, like we're going to make it really easy. Well, that really easy is what the bad guys prey on. And so we just have to make sure that in the process of making it really easy, that we're also putting in these stopgaps. And some of it might be coaching to the customer. Hey, I recognize that you want to send an instant payment to your trading partner for $50,000. Why don't you send $5 first, and make sure it all works, as an example.
Yeah. So what you're getting at, and that's kind of leading into the next question, which is how do financial institutions effectively balance that fraud prevention with a seamless customer experience? And it sounds like it's a little bit of coaching about how to use the product and how to maybe ramp it up. So a little bit of customer education, probably.
Yeah.
And
recent news, RTP just raised their per transaction limit to $10 million. And so even when it was at $1 million, I would speak to financial institutions and they would say, we're never going to go send, because I can't have people sending $1 million out of my bank in a single transaction that's irrevocable. And, when people say that, I have to back them up and say, look, that's the network limit. You get to build a product. When you build a product, you can set the product up whatever way you want. You can say your per transaction limit is $25,000. You can't do more than $100,000 a week or whatever, right? And so you cannot, you can't be an originator on the ACH network without having an origination network with an ODFI, an originating depository financial institution. And those relationships always specify limits, responsibility for returns, et cetera, et cetera. And so I think we really have to, while the hype around instant payments is, has reached a fever pitch, we have to back up a little bit. And as financial institutions begin to think, how am I going to build the products that have an acceptable level of risk while I'm still able to offer these products to my customer?
I think that's a very good point, that especially for the listeners and viewers of this interview are going to be, prospects and clients of DeNovo Treasury, which are smaller financial institutions. Those that are either just getting into instant payments or considering instant payments. And your point is extremely valid. Just because the clearinghouse says the limit is 10 million they have the ability to set whatever parameters they decide as a financial institution and define what that product is. I'm glad that you mentioned that, because that's an important key to this. It's very much like any other payment rail. You can kind of decide how you want that to work for your product. So I appreciate you saying that. So with what role do you think AI and machine learning could play in combating payments fraud, if at all, and what way would limitations be?
Well, I think, first of all, we've been using AI in fraud and risk management for 40 years. Okay. And it's always been something that's happening in the background, particularly in the card space, looking for errant card transactions. Of course, November 2022, OpenAI releases ChatGPT, and now everybody's talking about Gen AI. So artificial intelligence generally, I think, is helpful in fraud and risk detection. I think it will become more helpful when we talk about instant payments. We always have this conversation about, well, what payments am I turning into instant? Am I taking ACH payments and turning into instant? Am I taking wire? I'd love to take all my checks and make them instant payments, but what am I actually moving? And I recently saw a presentation by the Fed. They have I can't remember the title of the document, but it's something about the Diary of Consumer Payments Choice. And one of the things they talk about is cash. And they say the percentage of cash usage is declining, but then they put up this graph where the cash line is kind of flat, but actually going up a little bit. And the way they discuss that is the payments pie is growing. The number of payments being made is going up. In an instant payments universe, rather than a medium-sized corporation doing balancing between their various bank accounts on Thursday afternoons, they might decide to do it every day. In a world where I'm doing same-day wage access, instead of doing one payroll every 2 weeks, I'm giving somebody 10 payments in that same time period, right? And so I think we're going to see a lot more payments. We're going to see a lot more payment activity. And one of the things AI is good at is discerning patterns in very large buckets of data. And so, again, I keep leaning back in the ACH world. In the ACH world, regular ACH, 8 o'clock in the morning, Marge comes in. Marge has the exception list. She goes through the exception list and says, let that one go, let that one go, let that one go, send that one back, send that one back, right? We have to use AI to bottle Marge and do that on an instant and always on basis.
Very good. Thank you. Yeah, sometimes we forget that AI has been in our lives for a long time. It's just now we're bringing all these tools together, and that's really what happened in 2022.
Yeah.
Panic, right, when that happens. So getting into some regulatory and compliance considerations, how do regulations shape fraud prevention strategies?
Yeah, well, responsibility is my one-word answer to that. Like the regulations tend to define responsibility, or require the parties to define responsibility. We have to, in this part of the conversation, of course, separate Reg E, consumer from non-consumer activity, right? Because Reg E, Regulation E, out of the implementation of the Electronic Funds Transfer Act, protects consumers from unauthorized transactions. Earlier in the conversation, we talked about authorized push payment fraud. In those transactions, the consumer authorized the transaction, so Reg E doesn't apply. CFPB's been trying to kind of extend through FAQ the realm of Reg E to be able to cover that. It's going to be interesting in the new administration to see how far that can get pushed. The bottom line is, I think all of us, payment service providers, financial institutions, businesses, we all want payments to be perceived as safe, right? What we don't want to do is we don't want to let people off the hook for doing things that, were irresponsible. You've heard this before, Will, so you can cut it out of the interview if you want to. But, if if I go to a football game and I don't have a ticket and I want to scalp the ticket and I have $100 bill in my hand and I have a mobile app on my phone, I have Zelle on my phone, and I find a guy, he's going to sell me a ticket for $100, but he says, oh, for $75, if you send it to me by Zelle, I'll give you the same ticket. So let's take two scenarios. I give him the $100 bill, cash. I walk up to the gate. They tell me the ticket's no good. What do I do? Well, I'm a big macho guy. I'm going to run around the stadium, beat the guy up, and get my money back, right? But I'm not going to pick up the phone and call the Bureau of Engraving and say, hey, it's your fault. You need to give me my money back. But that same transaction done in Zelle, where it ends up that transaction didn't turn out the way I wanted it to, I pick up the phone and I call my bank and I say, I want my money back. And so we have to somehow figure out, how do we get back that sense of responsibility for your own actions? This actually applies to authorized push payment fraud, right? Historically, romance scams would happen in cash. And when they happened in cash, nobody picked up the phone and went back to the bank. Why? Right. Because they knew exactly what they did, right? And now they have this feeling, oh my gosh, it's somebody else's fault. I want to get my money back, right? And so we're going to be in a several year rationalization of that kind of responsibility.
I like how you're rationalizing all this. Very good. So what are the compliance challenges that financial institutions face with these?
I'm sorry, repeat.
Financial institutions, what compliance challenges?
Yeah. Well, so, the regulators are always focused on, are you following all the rules, and are you operating safely, and are you reducing risk for the financial institution, right? And so when it comes to send applications, which I know a lot of your constituency is not doing send yet, but they will eventually.
Hopefully.
They're going to have to be thinking about, how am I building these products? What's the level of money that I could be sending out? What's the level of money I could be receiving? How am I managing my liquidity risk? Because, liquidity risk, because, again, leaning on ACH, because ACH payments happen in batch, you have a pretty long period of time. You have a day or two to figure out how I need to move money around. And instant payments, it's going to be a brave new world. I think that everyone wants to serve their customers well. Everyone wants their customers to believe their money is safe in the bank, and using products provided by the banks is safe. And so I think, it was over in the UK where they had a Take 5 for Fraud campaign, big yellow hands plastered all over tube stations. And it was an education campaign, like, take time out, think about this payment. Do you really want to make it before you send it? And what they found out was the segment of society that becomes very vulnerable to authorized push payment fraud attempts, to scams, isn't reading the education, right? And so we are going to have to be a little bit better as financial institutions. We are going to have to begin to slow down payments. I'm going to go back to my Aunt May problem. And remember, Aunt May came in, said she wanted to do the wire. At some point, some bank manager said, Aunt May, we are not going to send this money, right? And what happened? Well, Aunt May slammed on the table. You're stealing from me. I'm calling the police. This is my money. All very emotional reactions, right? And so it stresses the relationship. So while we don't want to create that stress in the relationship, we are sometimes going to tell people, to protect the financial institution, we are making a decision to not initiate this payment.
Okay. That's good. That's good to know too. So this is going to be a topic I think you're really going to enjoy, and that's the technology side of this, and techniques for monitoring transactions and detecting anomalies. Like, what tools are out there to do that effectively?
There's all manner of tools for anomaly detection for authorized payment fraud. Again, because we've got 40 years of experience in trying to find these things. So, focusing in this answer on authorized push payments, scams, the challenge is the bad guy lives on the receive side of the transaction. And so if I go to my bank and I say, please send money to Will, my bank knows me. They know how much money I have in my bank account. They know your bank. They don't know you. And so I think as an industry, we're going to have to get way better at information sharing. The Fed also had another work group stood up, the Scams Information Sharing Work Group. I participated in that. We came out with an outline of the kinds of information that needs to be shared to be meaningful. And I hope that effort continues on, because as an industry, if I'm a sending financial institution and I want to send to your bank to do something, I need to know something about, if I'm fully on the hook for an irrevocable transaction, I want to know something about that recipient before I let the money go. And we see that in Zelle, as an example. They have confirmation of payee, meaning when I go to send you money, it says Will, or it says DeNovo Treasury, maybe if it's your business account. In the Zelle network, they've added signals between senders and receivers that begin to do a little bit of that information sharing. And in fact, that's helped a lot. The fraud numbers in the Zelle network, on a basis point measurement, are down significantly in the last couple of years. So I think that's one network, right? And so we need to figure out how to do that. Bad guys go to where it's the easiest place to steal money. I always used to say that when you turn the lights on, the cockroaches don't die; they go to somebody else's apartment, right? And so by making it harder in one network, bad guys are just going to go to another network.
Yeah. So do you think that institutions should approach, or how do you think institutions should approach like multi-factor authentication to enhance security? You have to have a varied approach to all of your risk management. You cannot get complacent. You can't run out and say, I'm going to buy this product, I'm going to apply this set of rules, and that's all I'm ever going to do. Because as soon as there's a fixed evaluation of a transaction, bad guys will figure out what that fixed evaluation is, and they'll just do something different. There was a period of time where one of the large credit card networks says, we're really only going to spend time evaluating transactions that are over $50. And what did the bad guys do? They sent through hundreds of $49 transactions. And so, particular to authentication and identity, I think first to comment on identity, and I'm going to give you a mental visual. And if you want to talk more about it, we can have another podcast. But we used to treat identity as linear. Somebody walked into the bank, I checked their ID, I gave them a toaster, they opened an account, I gave them a digital anchor to an online banking account, and that was it. Maybe I asked them to change their password every 90 days. You really need to start thinking about identity cyclically. Do I know who this person is? Is it a real carbon-based unit? Are they doing things they're supposed to do? Are they behaving within patterns? Has their pattern changed over time? And then you get to authenticators. So how am I trusting that this is the right person? I used to work with someone who said, it's easy to fake anything. It's hard to fake everything. And so you really have to focus on having a lot of vectors that you're checking and being able to continually check those. So particular to your question about multi-factor authentication and balancing between that customer experience, I mean, you enter your username, you enter your password, we ask you for your mother's maiden name, we ask you for a PIN, you got to open up your Microsoft Authenticator app. We could make a really secure experience that would be really crappy. And so I think you need to lean in on some mechanisms for authentication that can be done behind the scenes, just by virtue of the fact that they're in the app. I have signals from the last time they used the app. Where were they the last time they used the app, et cetera, et cetera. There's a variety of providers out there in the biometric authentication space. They can recognize that I normally hold my phone in my left hand and I type with two thumbs. And that's different than somebody who holds it in their right hand and types with one finger. And they can figure that out in terms of behavior over time. So I think that
summarizing, you need to treat identity cyclically, have varied approaches that you apply those approaches differently depending on the risk in the transaction. And I think it's okay that higher value or riskier transactions have a crappier user experience.
I would agree with you, but that's really fascinating that it gets down to the level of how you hold your phone and how you type on it, that they can get to that you can get to that level.
Yep.
That is fascinating to me. Wow. So can you share an example of a successful fraud prevention initiative and what made that effective?
Well, I can't name any names because, of course, the people treat this as trade secrets. But I think I hinted at one earlier, which is, somebody went live with Zelle. It was going great. They started getting a high incidence of fraud in Zelle. They unilaterally took the decision that says, hey, for any amount over this or for new payees, we're just going to slow it down. It turns out that in these push payment scams, in the moment when you tell Aunt May that she's being scammed and the person's really not moving from the Philippines and we're not sending the money, her visceral reaction is, you're stealing from me, I'm calling the police. If she goes away and removes herself from the situation for a few hours and thinks about it and can talk to somebody who's not, son, daughter, aunt, mother, cousin, who can talk to them sanely about it, they go, oh my gosh, you're right. That's not right. So it's kind of this, if it feels weird, it probably is weird, but in the moment you have a hard time making that decision. So slowing down the transaction cut their fraud for that particular class of fraudulent activity by over 80%.
Wow.
And I think that, so the way you build products, and by the way, that's a great example of something that had nothing to do with technology. That was strictly a product structure solution. Yeah.
Very good. What about new fraud trends or schemes that you're currently observing in the industry?
One of the things, you remember I commented earlier that the challenge we have here is the bad guy lives on the receive side of the transaction.
Yeah.
And worse than that, it would be great if the bad guy was on the receive side of the transaction, because then when I'm defrauded, I can pick up the phone, call the police, say, hey, go arrest Will because he's a bad guy. But it's not really Will's account, right? So there's a vast array of mule accounts through which bad guys launder this money before they exfiltrate it. And so finding patterns in mule accounts, again, requires information sharing, and it requires risk management at the network level. It's interesting. So the networks don't actually see who the senders are and who the receivers are, but they see patterns of where payments are going. And so to the extent that we can do network level fraud detection. And again, what happens when the network sees something? They're probably not going to shut down a transaction, but they can give a signal back to the sender that says, hey, red light, yellow light, green light, this might be a yellow light or it might be a red light. So think before you hit the send button. And I think cross-channel, we're going to have to figure out, it's one thing for one network to put in network level detection, but as soon as we do that, the bad guys are going to figure it out. They're going to move money to a mule account through what network? They're going to move it out of that mule account via another network or via check or via ACH or, send people to an ATM.
So as we look to close out today's episode, any closing thoughts, or do you want to conclude your comments in any way?
Well, after, one of the things we talk about fraud so much and it's like, oh my God, this is terrible. I'm going to stuff all my money in a mattress. I have high confidence in our industry. I really do think that the fraud fighters out there are good, that financial institutions have people who are working on this problem. The industry has people who are working on this problem. And I do think that, payment systems are safe. And we can continue to make them safe and, make them safer and keep them safe. So I do think we will prevail. And I think that, the people who are sending money need to recognize that they have a responsibility.
Yeah, and I'm going to make a quick segue before we close out. I feel good about it too. Is it that we're so close to it that we have this false sense of security, or is it, I feel like we know how to use the network, so maybe that's why we feel good about it. But I feel like you do. I feel like we've got a very safe and sound network, and if you follow the things that you should, that we're good, right?
Yeah. Well,
the right way.
Yeah, to use a boxing analogy, we're in the ring. We're in the ring getting pummeled.
Yeah.
We're taking punches to our face, and we might have won, but we still feel bad because we took a bunch of punches to the face, right?
Sure.
And so, you're right. You do have to step back once in a while, and I think, peer level comparisons, to the extent you can do them, making sure that I'm, the objective should always be I should try and always outdo my peers, because if we all try to outdo our peers in aggregate, we'll just keep getting better.
Yeah. Okay. Very good. Thanks for that perspective. And this has been a great conversation. You have such wonderful insights, and I'm so grateful that you're willing to share it with me and my prospects, and my clients, and my subscribers today. Can't thank you enough. Thanks so much for joining.
Thank you for having me, Will. And I'm pretty sure we'll see each other on the road.
I know that we're going to. It's going to be a busy 2025. And this episode is actually, our viewers will see that you've got the Grinch right over your shoulder there. So Peter is so busy that we are recording this over the holiday. This is going to show in February, right as the clearinghouse they raise that limit to 10 million right there in February. So this will be very timely as we talk about this subject and we release this interview. So thank you very much. And thank you to all the DeNovo clients and prospects and the DeNovo subscribers and followers and viewers and guests. And thank you for watching today's episode. Thanks, everyone. Thanks for tuning into this episode of In the DeNovo. For more content like the video we shared today, check out our website at DeNovoTreasury.com and our YouTube channel at DeNovo Treasury. Thanks, and see you next time.